So guys, today we are going to start a topic that is we are going to do practicals on mutual funds. We had completed two videos before this. It is a sequence of videos. So in the first video, we did some basics of mutual funds. In the second video, we completed types of mutual funds. And today we are going to apply whatever we had learned in the previous class, guys. All right. Starting from the practice and the practical part, guys. Now, whatever we had learned in the previous class, we are going to apply in this class. So, first, let me give you a few websites. In the previous class, I had told you that I will be sharing two or three websites with you. So, website number one is advisorkhoj.com. I will recommend this website. It's a good website. It's nothing advertisement. There's nothing. You don't have to share anything. There is no need to log in as well. You can use it for the research part. Website number two is Rupee West. It's again a good website for comparison. It has many tools, so you can use it. Again, there is no need to log in over here. It is completely free. Both the websites are completely free and can be used for the research part. Website number three is Morningstar. It is international websites. Very good website. Again, it's free and you will get all the data of your mutual fund over here. So again, it's a very good website, guys. Now, why we need to do research in mutual fund? First, we need to understand. Guys, if I tell you equity research, if the level of equity research is here, the level of mutual fund is quite low. It's very simple. Secondly, equity research involves a lot of steps. You have to see macroeconomic things, fundamentals, technicals, financial modeling. So many steps are involved in equity research. But in mutual funds, it's just few steps and few parameters that we have to see. It is just like IPO research. IPO research includes four or five steps. Similarly, the steps are very easy. Secondly, there are very less chances, guys, you will make mistake in equity in mutual fund research. Because even if you make mistake over here, your money will never become zero. The risks are not that high as in the case of equity. In equity, there are chances that your money can become zero, but in mutual fund it's not like that. So in mutual fund, the what you will lose the return part. Means if you would have chosen a good mutual fund, you might had made more returns. If you had chosen bad mutual fund, the returns will become low, but your money will not become zero. So that is a good thing over here. So research in mutual fund is quite easy, guys. We have to follow few steps, and we will be using few step method, and that will be more than sufficient to find a shortlist a good mutual fund. So let's dive in straight into this. Now, guys, yesterday in the previous class we had completed types of mutual fund. Now we all are aware what types of mutual funds are there and what are the returns that I can expect from the mutual funds. Now let's discuss this thing again, guys. So again, we need to first, decide which mutual fund we need to invest our money. To decide that, we need to first realize this thing, how much risk taking capability I have. First thing, if I can take more risk, I can get more returns. If risk taking capability is less, then you can expect less returns as well. Now guys, it's this research can be used for a personal investments, or you can become a broker, or you can become a distributor as well. So this will be very beneficial, right? You can give an ISM exam after these videos. That will be more than sufficient. You can start your distributorship in mutual funds as well. So whenever you will be consulting your client, you will be requiring this information, right? You have to see what is the age group of that client, how much risk taking capability that person is having. All right. Now, starting from the debt funds, guys. Debt funds are good, but generally, if I tell you, it is not that advisable to invest in debt funds. Why? Because generally, debt funds give you returns between 5% to 7%. So let's start from the debt funds first. So let's open any fund. Let's open this banking fund first. All right. So over here, guys, you can see, the average return you're getting around 6%, 7%, sometimes 8%. But the average return generally it lies between 6% to 8%. Generally, on an average, it's 7%. So let's click. Let's see which is the best fund. So see, guys, this is the AUM, right? So if I click in any of these funds, guys, So AUM of this fund is seven. It was around how much? Now, scrolling down, is the AUM 3,000 crores. Good fund, quite a large fund. Now let's compare this thing. So guys, over here we can compare the things with other investments as well. So if I compare the returns, for example, let's see the lump sum return. So over here I'm doing the comparative how if I would have invested in FD or RD, right? So if lump sum I would have invested 10,000 rupee and that too few years back. Let's give a timeline to this. So let's give timeline. 2010 would be a good timeline. February 2010, I started my investments and I invested how much amount? I invested 10,000 rupee. So guys, if I tell you over here, if I would have invested the same amount in PPF, let's see how much return I would have expected. So over here you can see uh, this mutual fund. If I would have invested 10,000 rupee, only 10,000 rupee as a lump sum amount in 2010. Now today my money would have been 23,000 and in PPF the money would be around 30,000. So if I say, PPF and mutual funds, they are just similar guys. 7% return, 7% return. So that is why what I wanted to say and what I wanted to convey to you that these debt funds basically they give you returns which are just equivalent to FDs and RDs and PPFs. Now, instead of investing in these funds, anyhow, guys, if you ask me, sir, is there any chance that, we are investing in government funds, for example, gilt funds are government funds. So, is there any chance that these government bonds can also default? Yes, absolutely. There are chances. Governments do default. I'm not going to get into that, the story of that. But what I wanted to say over here is that, guys, absolutely if you are investing in government bonds, again, you will be getting the returns around 6%, 7%. And still, there is some risk involved. At least some risk is there, right? Now, let's see over here, which is having highest AUM. So, SBI Magnum Gilt Fund, it is having highest AUM around 10,000. Let's see how it is. Okay. Let's open this one. SBI Magnum regular. So I hope in the previous class we had already discussed what is a regular fund, direct fund. All right. Now let's see how much returns we would have made if I would have invested in PPF. Again, guys, 7.7%, 7.1%. Margins are very low. So why to waste time or why to invest your money in debt funds? This is what I wanted to say over here, guys. And see, the risk is also quite low, moderate, but still there is a risk. But if you invest the same amount of money in PPF or FD or RD, that would be more advisable, guys. Right? I hope this is clear to everyone. So if you ask me, sir, are debt funds good source of good tool of investment? Absolutely, they are good. There's nothing bad or good in investments. If you have a lot of money, you should park your money over here. But my suggestion would be instead of parking your money in debt funds, we should go for equity funds. Equity funds would be giving you better returns. I hope this is clear to everybody. Now, whenever we are going to invest our money, we need to first decide what type of fund we are investing in. Means in which fund I am going to invest my money. First thing that I have to see. Second thing, in the previous class, we had already discussed this thing, guys. So let's open for equity fund. Equity mid cap would be fine, right? So in equity mid cap, we can easily expect returns around 20%, 18% to 20%. Now, the first thing that we have to see, guys, the AUM value, the asset under management value should be high. So we had already discussed what is AUM in the previous classes. I want you to see the previous videos for this. Now, if the AUM is high, it means that fund is handling this much amount of money. See, HDFC mid cap is handling 76,000 crore rupee, guys. It's huge amount of money. Kotak Emerging Equity is handling 52,000. So first criteria for you for investing should be AUM. Means higher the AUM, better the company is. Right? Now this is the first thing that you should be seeing. Second thing that you should be seeing, the launch date. Guys, it is advisable that you should have some historical data of mutual fund. So it is advisable that the lifespan of mutual funds should be at least 10 years, if not 10, 7 years. But you should not invest directly into a new mutual fund until and unless that mutual fund is exceptionally good. Means I would request you that in any NFO you should not be investing, because we don't have the historical data, guys. Historical data plays a very important role, very important role. So in all the mutual funds, try to see what is the origin date of that mutual fund. Nippon India is handling 34,000 crores. So let's see these funds. So what, let's see, guys, over here you can expect 1 year return is 31%. This is absolute return, guys, absolute point to point return. And this is CAGR, average of every year. So you can see 18% return you're getting from this one, 22% from this, 19% for this. That is what I was saying. It is around 18%. So in equity funds, if they perform better, if they perform good, guys, they can easily give you returns around 18 to 20%, sometimes more than that as well. So 22% return or 20% return is good, guys. If I tell you, if you invest today 1 rupee, and if you're getting 22% return after a few years, your money will also increase, right? So see, mutual fund is not a short-term game. I want you, why you should be doing so much research for mutual funds, guys. It's not like stocks. I buy today and sell it tomorrow. Once you are involved and once you have parked your money in mutual funds, that money will stay there at least for 10, 20 years. And only you will get to know the performance of mutual funds only after 20 years. So that is why if you put 1 week, 2 weeks, 1 month doing the research part in the mutual fund, that will save your 20 years. Because if you keep buying and selling in the mutual funds, you will have to pay taxes, brokerage, expenses as well. So this is also a very important thing. Now, HDFC AMC, SDFC Mid Cap Opportunity Fund Growth Plan. Now, yesterday we had already discussed what is growth. There are two types of investments, growth values basically. Growth means they are going to invest in the companies which they think which are going to grow in future, right? So it could be small companies and it could be the companies which are right now not growing, but they are expecting that they will grow further. Second is value plan as well. So value plan means they are going to invest in the companies who are undervalued right now. They are good companies, growing companies, but they are undervalued. The shares are undervalued. Their intrinsic value is low. Intrinsic value is high, but the valuation is low. So, for example, the company is making good profits, they are growing, but the share price is low. So, such kind of mutual funds invest in value plans. So, this one is growth plan. So, they will be investing in the companies which are going to grow in future, right? Now, all these things we had already discussed. This is a category. It is mid cap. One more thing, guys, I would like to tell you. In mutual funds, equity mutual funds, large cap gives stable returns. Large cap means big companies. The mutual funds who are investing in large capitalization companies like big companies, these mutual funds will give you optimum returns or stable returns, not very high returns. Mid cap and small cap mutual funds give very high returns, but the risk involved is also very high, right? Open ended, we had already discussed in the previous class. Launch date is 2007. Minimum investment is 100 rupee. So just see, guys, with 100 rupee you can start an investment. I want all of you to start investment. Nothing in this class should be taken as investment advice, but you should start as early as possible. 100 rupees just nothing, guys, nowadays, right? Benchmark is again a very important term. Benchmark means where the fund, no, with where the funds will be utilized and with which index the fund would be compared with. Means some funds are compared the investments of let's give you a very simple example. There is a fund manager. He he earns 20% returns on your funds, on your investments. But 20% should be related to something. Means there should be a comparison of that 20%. Means if Ferrari runs very fast, but to whom? If we compare Ferrari with, to whom we can compare that Ferrari. Similarly, if we are getting this 18% return, with whom we have to compare it. So the benchmark for this is Nifty Mid Cap. TRI means total returns. means including the dividend part as well. I hope this is clear to everyone. Total asset is again AUM. Turnover ratio, guys, again, it is very important. Turnover ratio is the churning rate. So if I am buying 100% shares, so out of those 100% shares, 20% shares will be removed and new shares would be coming. Means what I want to say, out of my 100% portfolio, 80% portfolio will remain the same this year, and by the next year, 20% portfolio will be changed. Sometimes this turnover ratio is 100% as well. Means all the portfolio which they had invested their money, they will sell it and rebuy it again, buy, invest in some another company. So if I tell turnover ratio, a turnover number in very, very simple terms, means, for example, this mutual fund had invested in the portfolio. This is a portfolio, right? So if it is 100%, turnover ratio is 100%, it means the fund manager will sell all these investments in 1 year and buy new investments. If this is 20%, it means the fund manager will sell few shares and keep these shares for next years. And and if he's selling these shares, he will add some new shares. So there is a churning ratio. Buying and selling are taking place. I hope this is clear to everybody. All right. Now, this is turnover ratio. Exit load we had already discussed, and Navy and CAGR. This CAGR since its inception means every year, on an average, 18% return you have received. I hope this is clear. Now, we can invest in SIP and lump sum. This we had already discussed in the previous class. All right. Now, if I would had invested 10,000 rupee, that too in 2000, let's see, 2012, for example, January 1st of 2012. This is the investment date we invested in this time, right? Now, guys, if I compare it with this Nifty mid cap, today my money would have been 1,45,000. Just lump sum 10,000 rupee, today would have been 1,45,000. And if I compare it with PPF, so let me compare it. So PPF, if I would have invested in PPF or FD or RD, my money would have been just 26,000, guys. Just see 26,000 rupee. And in mutual fund, my money today is 1,43,000. This is a difference, guys. So what I want to say, we are investing just 1 lakh rupee, 10,000 rupee, just once in lump sum. If I increase this amount and if I increase the duration, guys, my returns will also increase. So if I increase the duration from 2012 to 2010 this time, or maybe 2009 this time, 1st January 2009, in just 2 years, let's see how it works. Let me check it out. Now, guys, it would be 2,87,000. In just 3 years, the money is getting compounded. So that is why it is so important. So if you would have invested your money in FD, RD, the money in FD would be 33,000. That's it in FD, RD, PPF. But in mutual fund, see guys, it is 3,72,000. See the difference, guys. There is a huge difference over here. From just 10,000 rupee invested in 2009, today would have been 3 lakhs. So that is why start as early as possible. One more tip I would like to give you over here, guys. If you don't want to invest in mutual funds, if you don't want to, invest in mutual funds, you want better returns than mutual fund itself. I want you to shortlist top 10 mutual funds, top 10 or top 5 performing mutual funds of India, and see where they are investing their money, right? Which companies they are investing their money. And out of these companies now, do your own equity research and shortlist your own shares. You can find the name of shares over here as well. So you can shortlist your own shares and you can buy these shares directly. So this is also a good way of investment, guys. I hope this is clear to everybody. So this is the sector which this mutual fund is investing. These are the sectors. So banking sector, IT sector. So this is how the mutual fund is investing, and this is the list of the companies, list of the shares where it has invested. Now it is equity fund. That is why it had invested in equity, in only in shares. Few see there is a proportion that they can still invest in TREPs or bonds basically. So they can invest in bonds itself, right? So, but the major proportion over here is equity. So these are repo rates. Repo rates are bonds, basically. I hope this is clear to everybody. Now let's see Kotak emerging. So, guys, one more thing that you should be seeing over here is that you should be reading the investment objective, right? You should be seeing what is the risk capability. We are going to discuss this thing as well, indicators, Sharpe ratio, alpha, beta, what they are. We are going to discuss that thing in the coming slides. But we are going step by step. We need to see the riskometer, what is the risk, right? We need to see where the what is the portfolio where they are investing, and we need to compare the returns as well. What was the returns, 1 year return, 3 year returns, 5 year returns, and 10 year returns. We need to compare this thing as well. This is CAGR, guys, average return, right? These are not absolute returns. Now, if we compare it with equity mid cap and Nifty mid cap, so these were the returns. So we should compare it with its peers as well, how the peers are performing. See, so these are the peers, guys. So this is Kotak, and these are next other funds. So this is how we need to shortlist which fund would is doing. We need to see the historical data at least 10 years. It is advisable. Now, one more thing that you should be seeing over here, who is the fund manager? Who is the fund manager of this mutual fund? That is also because you are giving your hard-earned money, and that person would be handling your money, for next 5, 10, 20 years. What if that person is not competent enough? So this is also very, very important that whenever you are starting your investments, you need to see the fund manager as well. Who is the fund manager? So till now we had discussed few things. We need to see the date. It should be at least 10 years old fund. AUM should be as high as possible. See, there are mutual funds which are having 129 crore AUM. It means they are very small mutual funds, guys, right? Even returns are very, very low, 8%. Inception date is 1994. So it means this mutual fund didn't do well, right? So that is why AUM plays a very, very important role. Next important criteria for investment would be total expense ratio. Guys, over here I would like to give two contradictory statements. Statement number one, total expense ratio should be less as possible because you are paying commission or you are paying expenses to the mutual fund. It is impacting your returns. For example, you invested 1 lakh rupee in Reliance shares. The entire profit would be yours. Entire profit would be yours, right? Except giving the taxation and the brokerage fees to the broker like Zerodha or Upwork and Zerodha or Grow app or some taxes to government. Rest of the profit will be yours. But over here, the same 1 lakh rupee, if you invest in a mutual fund, you will be paying taxes to government, brokerage, and expenses. So there is one another factor that is getting added. So it's going to affect your returns basically. So guys, we generally invest how much? 1 lakh, 2 lakh, 10 lakh, 50 lakhs, 1 crore, 2 crore, 50 crores like that. Just imagine a person handling or investing 1,000 crore rupee. So over there, 1% would be huge, guys. For those people, 1% return, 1% expense would be very, very high. So try to see the total expense ratio should be as less as possible. It is also very, very important criteria. But one contradictory statement which I would like to give over here is that it's not whole and sole criteria that it should be as less as possible. Because expenses only if a mutual fund is doing good, the mutual fund would be hiring teams of people. Those team of people would be doing research. They need to have good softwares. So for that, they need money. So that is why they have high expenses. So the thing is that if sometimes expenses are high, but the returns are also good, that can also be considered because we mutual fund needs some high expenses just to manage their day-to-day affairs, guys. So it is also very important. One very important concept which I would like to tell you. Sir, if I invest 1 lakh rupee, right? So let's see the example in this way. If you invest 100 rupee, just for an example, TER is 1%, right? So when this 1 rupee will be deducted? Good question. Think. Means you gave 100 rupee to me. I am a mutual fund manager. 1% is total expense ratio. So should I invest 99 rupee, or means you gave me 100, or out of that 100 I should deduct my 1 rupee and then invest it? How it should be done? Option number two, when you will be redeeming your mutual fund, I should be deducting this expense ratio over their 1%, or it is done on day-to-day basis. How it is done, guys? How this expense ratio is calculated? Think, pause, let me know. So if I answer this question to you, the answer would be the expense ratio is calculated on NAVs, guys. It's very tricky, and it is calculated on day-to-day basis. You gave 100 rupee to me, and if I deduct 1 rupee at that point of time and I invest 99 rupee, that will be so heavy on your heart that you gave me 100 rupee and I took 1 rupee out of that. So you will not get to know when I'm going to deduct it. See, I'm going to deduct it when, you know, every day I'm going to calculate NAVs. So if NAV was 18 rupee, I will deduct 1 rupee from there on your behalf. So you will get to see NAV in 17 rupee only. I had already deducted 1 rupee from there. So every day, if one year I had to pay 1000 rupee as expense ratio, if it is calculated like that, so that 1000 rupee is not calculated one shot deduction. It's not when you are redeeming or when you are putting your money. It will be deducted on day-to-day basis. Every day I will be deducting from NAV, and you will not get to know. That is the art basically. So what I want to say, TER is deducted on day-to-day basis. It is calculated annually and deducted day-to-day basis. And this TER is how this is done. This is 2% of this complete AUM basically. So this 2% is calculated on this AUM. Firstly, secondly, if you are giving 100 rupee to me, I will calculate how much expense you will be charged per year basis annually, and then I will keep deducting it from your NAVs every day. So whenever you will redeem, you will straight away redeem it because I had already deducted from your NAV. I hope this is clear to everyone. So you don't have to confuse. But I want to say that it should be as less as possible. Sometimes higher amount is good, but the return of such mutual funds should also be very, very high. I hope this is clear to everybody. Now we had completed the launch date, AUM, we have completed the expense ratios and historical data. It is good to go. Now, there are few mutual funds that will come with some lock-in period. For example, children mutual fund. So if I click in SBI Magnum Children Fund, so it will come with some lock-in period at least 3 years. So over here you can see, so there is a 3 year lock-in period. So the exit load means whenever you will be redeeming, we had discussed exit load in the previous class itself. So whenever you will be redeeming your money, you have to pay some penalty. A penalty would be high. So it is the lock-in period for this is quite high. So lock-in period for this is 3 years. And similarly, it is for ELS as well, Employee Linked Savings Scheme. So they are mutual funds from where you can save your income tax under Section 80C. So these are ELSs. So it also comes with a lock-in period, guys. I hope this is also clear. So types of the mutual funds we had already discussed. There are sectoral funds and there are multiple types of other funds. So we are going to discuss this thing again just in a moment. Now, apart from all this, amongst all these guys, index funds, they are very important and they are very lucrative as well. Let's see how it works. Guys, if you don't know anything and if you want to advise someone to invest in a mutual fund, the best advice that you could give to someone is index fund. These are less risky. Now let's see a few examples on this. These are less risky and they invest your money in top 50 companies of India, Nifty 50 companies. Now, the benefit of these funds are number one, guys, top 50 companies will never default, they will never become zero, right? So, top 50 companies will always keep performing. So, that is why investing in these companies would be a good option. Now, let's see UTI next 50. It could be Nifty 50, it could be next 50 as well, right? So they had given good returns. If you can see over here, many of them incepted in 2018, 14%, 19%, 2021, 20%. These are new funds, 50%, 30%. On an average, more than 20% returns. Approx 18 to 20% return you can expect from here. But index funds are less risky. This is what I wanted to say. So UTI next 50. So we'll see over here so these they are investing the money in the next Nifty 50 companies. Next 50 companies. Similarly, there are multiple types of index funds as well. Some are Nifty 50 index funds. So it is more advisable to invest in Nifty 50 index funds or any index funds as per se. The returns would be better because these companies will anyhow grow. These Nifty 50 companies can never become zero basically. I hope this is clear to everybody. Now, guys, there were few funds. This we had not discussed yesterday. Funds of funds, funds of funds, and funds of funds. Means this is a mutual funds who is investing your money on multiple mutual funds. Let me repeat myself again. Funds of funds means I am a mutual fund. I took money from you and invested your money in three or four or five or 10 different mutual funds. Now you should think of why mutual fund would invest in mutual fund. So guys, what is happening over here is that, for example, I am an Indian mutual fund. I want to invest in mutual fund of America or companies of America, right? So I will buy American mutual funds. So those mutual funds would be investing multiple further mutual funds, right? So I am getting better options, means I am getting more options. Those mutual funds would be, see, I can invest in gold mutual fund, I can invest in international mutual fund, I can invest in, equity mutual fund. So I have multiple opportunities to invest being a mutual fund. But the thing over here is that, guys, the returns will decrease. So mutual fund number one means I am a mutual fund who invested your money. I will also charge the expense ratios. Then I will be investing your money in another mutual fund. They will also be charging the expense ratios. So again, the returns in these mutual funds could go down as well. So not advisable, but again, it's a new way of investing nowadays. People are investing in these types of mutual funds as well. Now, one more thing that comes into play over here are ETFs. Interesting thing, guys. Exchange traded funds. So it can be seen in two different ways. Way number one, these are the asset management companies who are registered in stock exchange. These are the mutual funds who are registered in the stock exchange. So people can buy and sell their units any point of time. This is the one way of saying this thing, one way of explaining this thing. Another way of explaining this thing is that you are my class students. You gave me money, I gave you units in return, right? You can sell these units in stock exchange. So again, that those are ETFs. So this transaction can go any point of time. So what are the benefits of this? They don't come with expense ratios. You can buy and sell any point of time, right? There is no concept of NAV over here. It is just exchange traded, just like stock prices. They keep on fluctuating. So like NAV, it is calculated by the end of the day, but ETFs, you can count, you can see the price of ETF any point of time. So the best example of ETF is gold bees, Nifty bees. So this is your homework. Just see the movement of gold bees, Nifty bees. I hope this is clear to everyone. Now, let's explore further how it works. Index fund is done. Let's see equity small cap, equity multi cap would be fine, right? Now, guys, one more thing that is advisable over here. It is important for you to invest in a direct plan only. This will save your money because if you are buying a regular plan, that regular plan is planned by a broker, by a distributor. So apart from this total expense ratio, broker will also charge or the distributor will also charge their commissions. So your returns will go down. So it is always advisable to use direct plans, right? And go for long run, guys. Spend some time in investment and then go for long run. That would be more advisable. So these are few plans. These are few, you can say, companies of multi-cap equity. So over here till now, I had advised you not to invest in debt funds. It is not advisable. Return would be around 7%. Inflation is also 7%. So real returns would be zero. But in equity, you can make good amount of money, right? So these are few funds which are based on uh, multi-cap. So let's see. Nippon India Direct Growth Plan. Mm, HDFC Multicap. Let's see this one. Guys, let me explore. Let me show you another another website as well. So HDFC Multicap Growth Option. Growth Option. I know you must be knowing now. Growth means they are investing in the companies which are expected to grow, expected to make more profits. So if, for example, the life of this fund is 2021, okay, Nippon India Growth Plan, okay, 2013. This could be good. So if I invest 1 lakh rupee, right, that too in lump sum, and time should be 2015, we could say. January 2014 is fine. Now let's see what will be my returns. SIP returns, it seems. Just a minute, guys. 2020, 2015 January is good, right? Hmm. So guys, this 1 lakh rupee would be 31 lakhs. Oh my God, it's good. Very, very good. This is okay. So guys, 22% return from this scheme. So what see, before this class now, it's not planned that which mutual fund I'm going to open. The thing is that this is how you have to find a good mutual fund. It could be accidentally, but see guys, the returns are quite high over here, right? So the thing is that this mutual fund, if the time will grow, it will give you insane amount of returns. So just from 1 lakh rupee, you are touching 20 lakhs to 30 lakhs. It's good return, right? So the thing is that guys, this is multi-cap fund. Multi-cap means this guy had invested in small cap, mid cap, and large cap itself. So see, why the returns are so high? Because they are investing in small cap itself, then large cap, and then mid cap. Because small cap gives you very, very high returns. I hope this is clear to everybody. Now, we need to see, for this fund, if you want to double your money, it will take 4 years. FD will take 11 years, gold will take 8 years, and Nifty will take 5 years. I hope this is clear to everyone. Now, this is how you need to do, your own tweaks with your research, and only then you will able to find better, results and better mutual funds for this. Don't just go on the advice of your bankers. Ask them, take the advice and then do your own research, guys. It is very, very simple. It doesn't need much. Equity research, there are so many steps. In mutual funds, the steps are quite easy. I hope this is clear to everyone. Now guys, there are few ratios over here. Let's see what these ratios mean. You should be knowing these ratios as well. First of all, beta. Let's start from beta. Beta means, guys, what kind of fluctuations market can have. So this is beta. It's a Greek word, right? So alpha. Alpha means what extra returns you will be getting. So Sharpe ratio and standard deviation. So first I'll give you an outline of this. Means we are not going into the formulas. I'm just going to give you English meaning of these terms so that you better understand these. Standard deviation means if it is 14, right? It means there is a chance that it can go 14% upwards, 14% downwards as well. So you can ask, sir, is there a chance of 14% loss? Yes, absolutely. But there is a chance of 14% increase as well. So standard deviation means it is a deviation, but both ways, upward and downwards as well, right? Now, then comes beta. Beta is the risk basically. What risk you are taking for what movement there would be in particular, you can say, investment. So it is a risk thing. Alpha is the returns which you are getting. If this alpha is greater than 1 or it's 1, it's good, guys. Sharp ratio is better. Sharp ratio and sharp ratio is the better outcome of calculation of alpha itself, right? So what sharp ratio, what it means, how much risk you have taken for the better returns, means how much unit risk you have taken for 1 unit of profit. So sharp ratio, if it is again 1 or more than 1, it is good, guys. So the thing is that these ratios you should be understanding. Yield to maturity is what is the return you will be getting, and average maturity means uh, what are the returns you should be expecting when the maturity is done. I hope this is clear to everyone. So the thing is that this is the riskometer, guys. If the risk is high, the chances of returns will also increase. I hope this is clear to everyone. Now let's explore another website. So this is also a good website. Rupee West is the name. So they are giving, once you open this website, there are tools section over here. In this tool section, you can click on mutual fund screener. So in this mutual fund screener, you can select, the equity stocks. So it will be giving you the options. For example, I'm choosing equity large cap. So these are equity large caps, just similar to the previous website. So AUM, expense ratio, exit load, returns, like that. Now you can add further things over here, what you want to do the research. For example, we can add filters over here, right? So these are the names of fund managers, guys. So I want you to explore the fund manager part as well. It is also very important who is handling the funds, right? Then moving further, what things you further want to use in this? Standard deviation, beta, Sortino, Sharp, and alpha. Now, thing is that Sharp is having some drawbacks. So that is why Sortino is the better, you can say, version of Sharp. That's it. It is just the same thing, rest, right? So you can use these, all the things. You can add these parameters over here. You can apply the parameters and they will be giving you these parameters can be added in the columns over here. The other thing is that this will make your research for the mutual funds quite easy, guys. It's not that difficult. So even if I click in any of these mutual fund, let's see the AUM. So this is having good AUM, Aditya Birla. Uh, hmm. So you can see all the things which were mentioned in the previous website itself. It is mentioned over here. So it will make the things quite easy. So portfolio will come over here. Guys, fact sheet is also very important. What happens every month, mutual fund has to release a document where they are investing your money. So this is a fact sheet. So in this, they will be mentioning all the things, guys. So I want you, being a finance student, research a fact sheet at your home. So whatever the data that was mentioned in these websites take the data from the fact sheets only. It is just like red herring prospectus of IPOs. It is a mandate. They have to release it. So over here, you should be reading the investment objective. What is the objective? All the terms would be mentioned over here, right? Where they are investing the money, that will be mentioned over here. The same data is picked by these websites, basically. I hope this is clear to everyone. So these are the portfolio where they are investing your money. So these are the list of the shares where they had invested your money. Guys, one more thing I would like to tell you, the investment should not be over diversified by the mutual funds. It should be optimum. Means if you are buying, if there is one person who is buying 10 shares, another person who is buying 100 shares. For the person who is holding 10 shares, it is very easy for him to manage those 10 shares. But if a person is who is over diversified and handling 100 shares, that is very difficult for him. Means handling so over diversified portfolio is also not good. So you have to see the number of shares this company is managing and how much is the churning rate, that also you need to see. I hope this is clear to everybody. So this is how you will be comparing the mutual funds, and you will be doing the research of it. It's not that difficult. Historical data, everything is mentioned over here. The best thing, the further, if you want to research, you can go to the website of this company. You can go into the website of this company, and you can website of Aditya Birla, for example, and you can research the same things over there. One more thing, you should be seeing who is the fund manager who is handling the funds as well. What is the experience that guy is having? What is the qualification that guy was having, right? One more thing that you should be seeing, please Google out the names of the mutual funds or AMCs. whether they are involved in some frauds, legal activities. So type in Google, just open the Google sheet and type over there. So you can type over there that uh, Aditya Birla Frontline Equity Fund fraud. Aditya Birla Frontline news. So you need to see the highlights. Is there any bad news, negative news linked with this mutual fund? Yes or no? Very simple step, but you should be following that. Second thing that you should be following, see who is the fund manager and see how many funds that guy is managing. That is also very important. Means if that guy is handling three mutual funds together. So it will be very difficult for that person to manage your fund as well because he's already handling two mutual funds. So your fund would be just an extra thing for him. So it is again very important that that guy who is managing the fund that should be having good time in his hands. So let's see ICICI Prudential Blue Chip. So again, one more thing which we can do is just click it like this, copy it. There's one more website, Morningstar. Again, this is a good website. Enter the name of a mutual fund over here and click it. Let's see. So here you get the details, guys. The thing is that this again website is quite, this website is again free and you should be using this website. This website is international site. Whatever data you will be requiring, you can get this data from here itself. I hope this is clear to everybody. Now, these are the three websites which are good to go and which are free to use everybody for everyone. So you can use these websites and you can shortlist at least top five mutual funds and then you can compare those mutual funds, right? What were the returns? And it will take at least 3 or 4 days or at least 1 week. Once it is done, guys, you're good to go because it is a long-term process. Instead of investing in mutual funds by taking advice of someone and investing in a wrong mutual fund and again redeeming it, it's not a good advisable thing. The better would be that you do the research and then do the investment part. I hope this is clear to everyone. So Advisor Coach is good website. Rupee West is again a good website. I want you to explore this thing. You can find so many, you can say, calculators, so many screeners, comparison parts, so many things are over here. And over here, Morningstar is also a good website, guys. So you can click in various types of you can find various types of data in these websites as well. So if you click on mutual fund side, so see you can get quite a good data on the mutual funds. Fact sheets are there. You can find the fact sheets over here itself. So if I click on the fact sheets, let's see. So you can find the direct fact sheets over here itself. Yes. Apart from this, if you want to screen the funds, you can screen the funds from here itself. Aditya Birla Mutual Funds. Let's see Aditya Birla Mutual Fund. So all the Aditya Birla Mutual Funds you can find over here, and you can do the research part from here itself. So these are good websites. You just need to invest some time for these websites, guys. That's all. I hope this is clear to everybody. Now, if I summarize myself for today, guys, mutual fund research is very easy as compared to equity research. Equity research involves so many steps. Mutual fund research and IPO research are quite easy. It involves very easy steps, right? Secondly, mutual fund investments, you will never go wrong in this. Even if you find a bad mutual fund, that mutual fund will give you less returns, but it will not make your money zero. So you don't have to worry. Thirdly, you need to put a habit of doing the research part. You just try to open these websites and try to explore these websites a bit. It will really help you to become, and whenever you face any doubt over here, try to YouTube or try to, will be, making few videos in the further classes itself. So it's not done yet, guys. It's not the mutual fund part is not done yet. We will be going deep into the details in the next coming videos. This was just a glimpse that we are going to discuss this thing in this manner. So in the coming classes, we are going to discuss how the fact sheets are made, how the NAVs are calculated, how these ratios are calculated, Sharpe ratios, Sortino ratios, alpha, beta, how these things are important because we are not entering into mathematical part right now. I hope this is clear to everybody. Now, I hope uh, I did some upskilling in your present knowledge, guys, and I am really thankful that you listened to me so patiently.